a robust labor market, a strong consumer, strong corporate earnings, strong balance sheets across the board, both in the corporate sector and in general for households, to provide the environment for economic growth to reaccelerate and for inflation to potentially turn up going into 2024. And that would, realistically not be great for risk assets.
On this episode of Early Bird, AJ Giannone, Chief Investment Officer at Allio. AJ joins the podcast today to talk about inflation resurgence and the impact on stocks in 2024, including why those expected interest rate cuts might be delayed. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you how you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, AJ, welcome to the Early Bird podcast. How are you doing today?
Oh, I'm terrific, Stephen. Thanks for having me.
Well, thank you for joining. We're going to talk about a very serious topic today, certainly a topic that's on the minds of our listeners and investors out there. It's inflation resurgence and how that could impact the Fed and the stocks in 2024. But before we get to that, AJ, if you could, in about 30 seconds or less, what should the audience know about you and your background?
Sure. So my name is AJ Giannone. I'm the Chief Investment Officer at Allio. We're a startup wealth manager looking to provide investors in this kind of new macro climate with a differentiated investment experience. We have, the background of basically trying to inform investors for, how to handle this unique environment that we find ourselves in. And things have changed, obviously, dramatically since the zero rate environment of pre-COVID. So, our background and mine specifically is in asset allocation, tactical investing, strategic investing, risk management, and really trying to give our clients and our investors an edge when it comes to how to dynamically adjust portfolio exposures in environments unlike we've seen in a very long time.
Yeah, you mentioned zero rate environments. We had very low interest rates for some time, and then the past year or two, we've had higher interest rates as the Fed tries to combat higher inflation. Now it's a different story in 2024. So AJ, catch everybody up to speed. What's the situation with the Fed and interest rates and inflation as we start 2024?
Sure. So to take a step back, we saw inflation accelerate fairly dramatically, going into the year 2022 and throughout, that year, you saw the Fed raise basis points 525 on the Fed funds rate, well in excess of the speed that they had in any real meaningful historical context since the 70s. So from our perspective, we were watching alongside of these rate hikes and alongside inflation, specifically measured by CPI peaking at over 9%. And really, where we are now is we're on the back end of that, right? We've kind of come through the gauntlet. Investors are looking out at inflation, coming down through the single digits, and now we're, in the threes. Most people, I think, feel like inflation is kind of in the rearview mirror. The Fed has signaled that they're effectively planning to pivot to a more accommodative monetary policy stance and a framework. They're looking at, potentially doing some rate cuts here in 2024 and, potentially talking about kind of toning down their balance sheet runoff or their, effectively selling and disposing of some of their balance sheet assets, kind of the reversal of the quantitative easing that we saw, in the zero interest rate environment of pre-COVID. So, what that means in practical terms for investors is that financial conditions over the last, call it 9 or 10 months have really been easing. They basically peaked around the regional banking crisis that was precipitated by Silicon Valley Bank imploding, and some others like Signature and First Republic. So, basically after that time, you've seen financial conditions just slowly and steadily start to ease a little bit. And, when you look at what that means for investors and for capital markets and for asset allocation, generally speaking, one of the key drivers of asset price returns and market performance is really the liquidity environment that we're attempting to asset allocate inside of and to make investments inside of. So when you're thinking about the liquidity environment, having an environment where financial conditions are increasingly easier, where credit is more easily accessible, where capital is flowing more freely, ends up being fairly bullish for equities and for risk assets usually. However, this situation may be a little bit different, right? The Fed is in a unique predicament where they've explicitly stated their goal to get inflation, whether you're measuring it via core PCE or CPI, back under a 2% target. And we're not quite there yet. So as financial conditions have eased, you've started to see a reacceleration in some interest rate and financial conditions sensitive areas of the economy, specifically housing, specifically construction spending, specifically consumer spending. And those things together are inflecting upwards at a time when most folks are looking for continued easing from the Fed. So it's highly likely, in our view, that the combination of the financial conditions easing throughout the back half of 2023 in combination with a robust labor market that really has never put the brakes on in a way that the Fed, I think, would have otherwise preferred, it has really set the stage for a robust labor market, a strong consumer, strong corporate earnings, strong balance sheets across the board, both in the corporate sector and in general for households, to provide the environment for economic growth to reaccelerate and for inflation to potentially turn up going into 2024. And that would, realistically not be great for risk assets, stocks, bonds, real estate. Like you saw in 2022, really the only thing that did well in a rising rate environment was U.S. dollars, and almost every other asset class across the capital spectrum and across the efficient frontier performed, basically put up a negative number. So, if you want to talk about where are risks for 2024 that aren't really being accounted for, that's where, in our view, investors maybe have turned an eye a little bit too soon to the inflation is done fight and said, the Fed's done. They beat inflation. We're back on the risk asset train. Everybody, just get on board, load up on stocks and risk assets, and we'll ride this bull market up, another 3 or 4 years, and it's set it and forget it. And that maybe not be a little bit of hyperbole. It might be, but I think at least it seems to me the attitude that you saw at the back end of last year. I think there's still a fair bit of maybe pessimism or the recession's coming kind of talk. But it's always framed in the context of it's going to be a soft landing, and then we're looking for a reacceleration in the second half of 2024. So you don't see anybody talking about. Go ahead.
I just got to ask. So you're talking about some of the negative stuff, which I want to get into in a second. But real quick, very very briefly, just so we're clear to our listeners, the rosy picture that some investors have right now is that inflation will continue to drop, and thus the Federal Reserve will lower their interest rates eventually in 2024. And this will be good for many stocks, particularly those riskier stocks like in technology, which will benefit in a lower interest rate environment. In a nutshell, that's sort of what's going on in a rosy picture, correct?
Exactly. So, technology stocks, stocks with, that higher gearing towards longer duration cash flows, stocks with less profitability, stocks with weaker balance sheets, all of which suffered maybe disproportionately throughout the rising rate environment, have really rebounded in a fairly meaningful way since October of 2023, a few months ago. So that phenomenon of reversion to the mean, or these assets were the ones that did poorly. Now in a declining rate environment, the assumption from those folks is that these assets are going to continue to do well in a declining rate environment if the Fed is correct in its assessment and it does go forward with rate cuts throughout the year here. Although that's really where I think the skepticism is will they be able to get to those rate cuts?
Good point. When we return, we'll hear from AJ about the types of stocks to invest in this year in case inflation comes back. But first, let me tell you how you can become a more informed investor through Early Bird, a free daily email newsletter. Early Bird has commentary on the latest events and trends in stocks, cryptocurrency, and crowdfunding. With Early Bird's daily weekday email, investors can quickly stay on top of the trends and beat the market. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, back to today's discussion. So, AJ, today we're talking about the Fed and inflation and interest rates. We talked a little bit about the rosy picture before, but I want to get to your thesis. You're saying that inflation could resurge and come back in 2024, which would push back the interest rate expectations that we have for lower interest rates, and that would be bad for stocks. Well, in a nutshell, tell me why that might happen. I'm curious. Why do you think inflation might return in 2024?
Sure. It's really a combination of two things. It's the easing financial conditions, which in a very loose sense allow for both businesses and for consumers to spend more freely, to consume more, to invest more, to purchase more goods, to transact more. And that phenomenon is part of the effect that we're looking for that would, potentially put more pressure on the buy side of these transactions, thereby raising price levels and thereby pushing inflation as measured by either CPI or PCE higher. The other piece of this is one of the core phenomenons that you saw with respect to the rising rate environment was the impact on real estate and the effective locking up of a lot of different real estate sectors. Everyone makes a big deal out of offices and that sector of the real estate market where which has obviously been quite severely impacted by the rising rate environment and basically preventing transactions from even happening. A lot of restructurings in the loan side. So if you think about what a declining rate environment does, or an easing of financial conditions, it basically greases the wheels of those transactions a little bit, and it would, in our view, push some of those transactions through again, driving prices up and potentially pushing that through to CPI. And if you remember, one of the big pieces of inflation is housing, both in the home prices as well as rents and rental agreements. And the impact that you saw in home prices in a real-time sense, if you look at measures like, the Zillow home index as opposed to the housing component of CPI as it was officially measured, Zillow, I think, and others like it, captured what was happening in a much more immediate sense throughout the COVID environment, starting in 2020 and now through 2024. Whereas the CPI component that, housing constitutes was much more delayed, to the tune of about, 18 to, potentially 24 months. So, as we see the housing component of CPI, kind of cooling down here, in January, as it was released a few weeks ago, the upshot of that is, if you look at the more real-time metrics that, are available through via Zillow and others, they necessarily haven't, continued to decline. You've started to see a little bit of a different trend there. So, if you look at those things together, you look at financial conditions easing, you look at the robustness of the consumer, you look at the strength of the housing market, the strength of the rental market. There's certainly areas of weakness and, potential, pockets of uncertainty or risk in all of those factors. But on balance, if you look at all of them in aggregate, there's really nothing that would prevent GDP from accelerating from here. And I think the weight of evidence suggests that GDP will accelerate from here. When you look at what that means for inflation, the upshot there again is that, a higher than expected GDP print would be the result of more active economic activity, both in the consumer and the corporate sector, as well as in the housing sector. All of those things would, really conspire to push prices up. And I think there's a maybe lack of attention to that particular scenario at the Fed. I've been fairly critical of the Fed, over the last couple of years, as it's kind of been behind the ball in its attempt to get inflation under control. Obviously waited until inflation was already rapidly spiking before it really made any attempt to put in place restrictive policy. And they kept, policy extremely accommodative, well past the point when it was, really necessary in the wake of the COVID liquidity crunch in 2020. So there's an element of that, they tend to be behind the ball a little bit. They, I think, are suffering from, a little bit of a hindsight bias with respect to their experience going through, the 70s and stagflation and some of those, more extreme inflationary environments. And I don't think they're necessarily, looking forward with as much foresight as they should.
Understood. So AJ, if this scenario plays out where you're talking about inflation going up and the Fed has to pivot and all those rate cuts that we're all expecting, if they get delayed, what would stocks look like in 2024? And are there any sectors that you would maybe gravitate towards or stay away from in that scenario?
Sure. So it would basically, in our view, be a repeat of the playbook of 2022. If what we're kind of predicting it comes to pass in a way that would be, economically meaningful, then the same kind of assets and sectors and stocks that did really well in 2022 would continue to do well in 2024. And that's a very limited subset of stocks and of assets, right? There are, if you look out at equity valuations here, they're fairly stretched to the upside given what we know. So, on the one hand, a stronger economic climate, I think, would provide a little bit of a buffer there. But on the other hand, you're looking at applying a much higher discount rate again in a period where I think a lot of folks have already baked in quite a few rate cuts into their valuation models. So, the sectors and the asset selection, I think, is going to be paramount. I think on the equity side, as cliche as it is to say, the high growth tech names, locally known as the Magnificent Seven, and a handful of few others that have a really strong moat, really robust organic growth and have spent the last 18 months trimming some of the fat around the margins are going to continue to do well in any environment. I don't really think that they're as dynamically exposed to some of the monetary policy effects as others. The high growth, low profitability tech startups and the small caps and others that are more on the weaker side of the financial balance sheet equation are going to suffer disproportionately. So I think the areas where you want to be are in profitable companies that have a high degree of quality. Think the Warren Buffett style of having a moat, a strong balance sheet, robust earnings growth with quality management, and really avoid the more casino style long shots with the 100x price to sales ratios. I think that's probably the most prudent move that we'd be recommending. The other thing to think about too is that when you're looking at sensitivity to interest rates, it's not just stocks, right? It's bonds. So when you're looking at some of the fixed income areas that did reasonably well in 2022, those are interesting as well. Areas like leverage loans and high yield bonds in an accelerating growth environment where credit is relatively easy to access and economic growth is strong, we would expect those sectors of the fixed income universe to perform relatively better than some of the longer duration assets. So you'd want to avoid the 10 and the 30-year treasuries, the long end of the curve, and really any of the corporate or other issues that are out there, in the duration ladder as well. You'd be looking for, the areas where the higher coupon rates, specifically in high yield and call it the leverage loan or the private credit style of lending, give you that nice buffer against potential rate increases.
Wow.
If you're pulling down a 9% coupon, like you were in October of 2023 in the high yield market, you don't particularly care if rates go up another % or two. You've got a little bit of an offset there from your coupon payments to help impact the duration component of your total return.
Yeah, it's like 2022 all over again. Oh, AJ, thank you so much for explaining what could happen if inflation makes a comeback and what the Fed might do and how that might impact stocks. It's an incredible thing that investors should really watch out for in 2024. AJ, thank you so much for coming on the Early Bird podcast and explaining all that. But before we wrap up the podcast, I just have one final question for you, AJ, and it's the most important question for today's discussion. That question for you, AJ, is if you had an autobiography, what would the title of that autobiography be?
Oh, Stephen, well, it's been a pleasure to be here, and thank you for giving me the opportunity to have this discussion with you. It's been a real honor and a treat. That question, though, is a tricky one. An autobiography title it's a humbling kind of thing to ask, right? But the title of it would probably have to be, hard lessons learned or I'll get it right next time. One of the core, I think, beliefs that I've tried to carry with me through my investing career has been, you learn more from your mistakes than you do from your victories. And that's something that I think, a lot of folks would agree with, but it's really, what you learn from those mistakes and how you apply that to, your subsequent attempts at, whether it's investing or entrepreneurship or, your personal life that I think is a really powerful and meaningful lesson to take away from it. So on second thought there, y'all have to go with, I'll get it right next time.
Good one. Thank you again to AJ Giannone for sharing your insights on inflation and stocks in 2024. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.